So today's Cardinal lesson is the fourth in a series of 4 videos about Tom and Chelsey and their situation with retirement and financial planning. And the highlight of today's show, or the topic, is the hybrid life long-term care insurance purchased with IRA money. And so when you look at Tom and Chelsey, is of all their assets, which are pretty extensive, they've got $2.5 million of IRA money. So, and they also have $750,000 of taxable investments and almost $1 million in money that they've already paid the taxes on, but we're going to deploy that in other places. This is popular where people will deploy a chunk of their IRA money. In their case, it's about 10% of what they have to purchase a single premium long-term care insurance policy. So to give you a little background, on the first video, we created the retirement income plan for Tom and Chelsey. And what that did is really got them the $12,000 a month monthly spend after taxes. And we were able to delay Social Security so we would get a much larger check. And we were able to replace the Social Security with a single premium immediate annuity, or just create a check out of mostly tax-free or already tax-paid money for the $12,000 a month. In addition, we have, when that one stops at the end of 5 years, we have another one that kicks in, that then the income lasts for the rest of their life along with the increased Social Security. In the second video, we went over Roth conversions and put together a Roth conversion strategy, because this is a problem to be reckoned with, is that they would simply, if Tom and Chelsey would just take as little as possible out of their IRA till 75 when they have to, and then continue taking minimum distributions, they've got a tremendous tax problem for putting off distributing the IRA that's going to be created for them or their heirs. And then, what we really come to is, in the third video, we talked about the actual delaying of Social Security, and we got into the nuts and bolts in the proposed plan of why they would wait 5 years to begin collecting Social Security, which leads us to today's video, which is probably the most impactful thing that we do for people, is figure out a way for them to effectively pay for the use of long-term care. And so I want to turn it over to Tom, and I want Tom to talk about why we're doing this particular video today.
Yeah, I mean, we're doing this video because Tom and Chelsey, they had experienced a long-term care situation with both of their parents, right? They went through this and they saw what that did to them as the children of the people needing care. And they knew they never wanted to put their kids through the same thing they went through. And so this was important to them to sit down and try to plan for this. And so as part of this larger plan, and we'll get into the details as we go through the show, this was important that we planned for this. We had a plan around how do we provide the money to provide for the long-term care if it happens. Hopefully they never need care, right? The ideal scenario is they don't need any long-term care. But they know if they do, who bears the burden of that is their kids, and they wanted a plan to prevent that from happening. So, Hans, why don't you go through a little bit? Well, actually, let me bring up the show notes first. You can find these show notes at the link below on our video. They're also on our website. We have the board as always. We have more details. We're going to come back to the show notes here in a little bit. We have the proposal that we're going to walk through. But again, let's put some context there. We're going to spend a little bit of time in the software like we have on the other videos because it's all on the same case study. But this one, we're going to spend a little bit more time in the details of the policy here. So give us a little bit of context, Hans, how it works, then we'll go from there.
Okay, so what we're proposing is they would take $250,000 of this very large IRA, and they would roll it over, or they would transfer it custodian to custodian from where it is to the insurance company, to an IRA in the insurance company. So they're not going to pay any taxes in this initial transfer. The $250,000 sits in the IRA, and then from that, there's a deduction made each year for 10 years to pay the premium on a life long-term care policy. And then at the end of 10 years, the IRA is depleted, So it has zero in it, and all the money is moved over in 10 equal installments over into the life long-term care policy. So that's about as simple as I can make it. Tom's going to give you some details later. Um, but what people like about this is it accomplishes a number of objectives. First of all, it purchases long-term care insurance where from their budget, they're not having to pay a substantial premium for the rest of their life. Um, People like that, where it's single premium long-term care, essentially. And what it's buying on the life long-term care side is $9,600 a month of long-term care benefit that can be used either for home health care, it can be used for facility care like an assisted living. It also can be used for non-professional home health care, um, not at the full benefit, at a reduced benefit. So I don't want to get too much into the details here, but it's pretty substantial coverage, especially when you consider the fact that it's a lifetime benefit. So it's not a 3-year benefit or a 4-year or a 5-year. It is unlimited for both Tom and Chelsey. So it's pretty important. And if they are needing care, and as we look to the future with the rise of dementia and memory issues and how long people are living with memory issues, is we don't know 20, 30 years from now whether a lot of what is 4 years now might be 10 years. This policy neutralizes that because and protects you against that because it has an unlimited benefit. So what we've got over here is a summary of $250,000 of IRA transfer, and then from the IRA is deducted $31,250 a year of annual insurance premium for 10 years. So the premium is going to be paid out of this initial $250,000 transfer. Tom's going to give you some details about that in a sec. If Tom and Chelsey were to die in an accident or something in the reasonable future, never use their long-term care, there's a death benefit on this policy of $230,000. Or even if they both died way in the future and they never used the long-term care, at least this money is not gone. It is going to go to their heirs, $230,000 tax-free. Now, if they had used it for long-term care, but not used a lot, is that they had used like a year of long-term care or 7 months or something, and then died, and the other one passed away without using it at all, well, then whatever they collected out of the policy would be deducted out of the $230,000, and there would still be a death benefit. It would just be smaller. But if either one of them uses it in a substantial way, there will be no death benefit because they're going to blow right through that and collect potentially millions of dollars out of this. And I just want to emphasize that this is an unlimited benefit for both of them. So I want to push it back to Tom, and I know Tom wants to show you a few things in Tom and Chelsey's financial plan for how this thing works.
Yeah, so what we're going to do is we're going to take a look back at the software again. If you've watched the other 3 videos, this is the same case study, same set of clients. We're going through and illustrating this, but I don't need to go through all the profile stuff. We've been through that on the other videos. But I want to go to the retirement tab. Again, we've spent some time in there already. And this maybe isn't a screen we've looked at before. So when it's running through these Monte Carlo simulations, that's where it runs through 1,000 different scenarios based off of the fluctuations and potentially what could happen in the market. Again, I don't want to get the video's not on that, so we don't want to spend too much time here. But graphically, this is what's going on, right? These are all these different variations of these Monte Carlo simulations, and I just want to illustrate what happens at the end of the plan here. Is there's a downturn, right? Is they're needing care. We've modeled them only needing 2 years of home health care, and so that's sort of one of the lower types of care you can get, especially if it's not 24/7, which is not what we've modeled. So this is like needing people 4, 5, 6 hours a day for 5 days a week is about what we've modeled here. And then we've inflated that cost for the future. So it's a much higher number than it is currently. but we've only done it for 2 years. And so even at that, we have this sort of downturn happening at the end of their lives because we're needing care. And so this just really sort of illustrates the risk of it. There are levels of care that are much more expensive than home health care. If you need some type of memory care, if you're in a skilled nursing facility, it's a lot more expensive, or you can need it for a lot longer, right? We've only done 2 years. So this is a real risk to their plan. Plus, they've had the experience. They know what they've been through. And again, they don't want to put their kids through that. So I just wanted to show that. And then what I want to do next is, again, you can find these at the link below, and give you a little more context. Hans went over a lot of the details here. But again, this page gives you a nice summary, right? We have the $250 of IRA money going in. There's the death benefit of $230 that comes out if they never need care. And then there's the $9,600 a monthly benefit per person. That's lifetime. So if there's a scenario where both Tom and Chelsey need care at the same time, that's double, right? It's almost $19,200 at that point, right? It's a lot higher number if you need it because it covers both people. And the real sort of nice thing about this particular policy, it has lifetime coverage. Is there is no end to that. If you've had some type of, and this typically happens with like dementia or Alzheimer's, is if you have really some extended level of care, you need it 6, 7, 8 years, this will pay for as long as you need care, which is a really nice thing. But again, the nice thing about using a life insurance as sort of the base policy on this is it's paid up from day one. That initial $250 is the only money that you're transferring to them. They can't raise premiums, which historically long-term care policies have had a pretty large rate increases. And there's this death benefit component where if you never need care, at least some of that money is coming back to your estate, to your beneficiaries tax-free. The next page gets a little more into the details, but I think sometimes it's helpful to see this on the page here. What they're doing initially with that $250 that gets transferred over is that's going from an IRA to an IRA. So there is no taxation at that initial transfer of the $250. What One America then does, that's the company that offers this policy, is they put that into an annuity that pays out 10 equal payments for 10 years. And they give you some interest, right? I mean, you put $250 in, you're getting $31,250 out over that 10-year period of time. So it's earned interest there, and then it's paid out, and that's the premium of the life insurance policy, the life long-term care policy. And so that's coming out automatically for the 10 years. You do have to pay taxes on this annual distribution over those 10 years. But if you remember back in Tom and Chelsey's plan, we have this plan to do Roth conversions, which is drawing down their IRAs, intentionally paying taxes to get it into something tax-free. This fits very nicely within that larger plan of doing the Roth conversions, because essentially what we would do is just reduce the Roth conversions by this dollar amount. Effectively, we're doing the same thing. We're taking money that's pre-tax, that has not been taxed yet, get it into something that's tax-free, because all the benefits out of this policy are tax-free. The death benefit is tax-free. If you need it for long-term care, that's tax-free. So there's some real tax benefits to doing this as well. But really, it fits nicely within that larger plan of drawing it down, systematically moving it into something that isn't taxed while covering their largest risk of needing some type of long-term care. Some of the questions that we'll get often say, okay, that sounds great. What happens if I die, like in the 10 years, right? I mean, I've transferred over this $250. I know I have the death benefit of like $230, but is that $250 just gone? And that's where this sort of middle column, his total death benefit, shows that. And so no, that $250 is not gone. It's being drawn down, so it's being reduced. But if you were to die during that 10 years, your beneficiaries, and I guess this is a joint policy, so both of you would have to die. Both Tom and Chelsey would have to die. But if that happened during that 10 years, the remaining IRA would still go to the beneficiaries on top of the life insurance policy. And that's why this total death benefit actually decreases for the first 10 years, and then it levels out. But at the end of the day, the death benefit is not the primary reason we're doing this. What we're wanting to plan for this here is the long-term care benefits. It's getting money to the care providers so the kids don't have to bear that burden of providing that care or trying to figure out how to pay for the care, right? I mean, objectively, Tom and Chelsey have the funds. If they wanted to self-fund this policy, they could, but that doesn't look real pretty at the end of their lives. The kids are trying to figure out how they fund this. Unfortunately, sometimes kids get in there and it feels like they're spending their inheritance on taking care of their parents, which hopefully doesn't happen, but unfortunately we see it a lot. And then what ends up happening is the kids say, well, I could do that. I could provide that care. We don't need to hire anybody. So you're not getting the care you need. You're not giving the same level of care you need. I've talked about my experience with this just personally in other videos, but it's just not a real pretty sight. Plus, it's having your kids put their life on hold. If they're working, they're not having to maybe take time off to take care of you. It just really does not work that well. So it's nice to have a policy in place to fund the need for the care if that were to arise.
What we want to do is just talk about how does this fit within the scope of financial planning. So we're purchasing long-term care insurance, long-term care protection, and we're doing it with IRA money, with a single transfer of IRA money. And that's about it on the video. I mean, people, and they're buying the protection that they need. Now, added to that, we're protecting their estate. We're creating benefits that are tax-free. So all the money coming out of the policy ultimately is tax-free, other than what comes out of the IRA. That of course, they're going to have to pay taxes on. And when we look at all 4 videos and look at the whole case and the financial plan that we did for Tom and Chelsey, we covered all the boxes. We created an income plan. That's what we started with. We created a big change in how they're going to take their Social Security. And probably the only box that we didn't touch on is Medicare. And ironically, that's the product that they came to us in the first place for. So I want to bring Tom back on. I'm Hans Scheil.
And I'm Tom Griffith.
We thank you very much for listening.
Thank you.